Everyone who invests makes mistakes. The question is whether you make ones that are easy to avoid. Today, we're breaking down the 5 biggest investing mistakes people make. Even better, we're bringing in a very special guest, content creator Joyee Yang. As it turns out, research shows men and women tend to make different investing mistakes. Today, we're going to look at what might be blind spots for both sides.
It's great to be here on Money Focus. The data on how men and women approach investing differently is fascinating. I'll be weighing in on each mistake with that in mind.
Mistake number 1 is waiting too long to start investing. This one is brutal because the damage is ultimately invisible. You don't see what you're losing by waiting. As we've pointed out before, compound growth is unforgiving. Every year you delay is exponentially more expensive than the year before it. The fix is simple. Start before you feel ready. Perfect is the enemy of good. A small amount invested today beats a perfect plan that never launches. Open the account, make the first contribution, adjust as you go.
This one might hit close to home for a lot of women. Studies show that women are more likely to wait until they feel fully prepared before investing. On the surface, that might sound like the responsible thing to do, but in practice, it means years may go by without ever getting started. Some may feel that there is still more to learn, which delays the follow-through. Financial spaces have not always been welcoming to women, so wanting to feel confident before stepping in makes sense. But the market doesn't wait for anyone. Starting with a few bumps at the beginning beats not starting at all every time.
Mistake number 2, emotional trading. This one tends to skew male, and the data backs it up. Men tend to overreact to market movements, panic selling when things drop, or chasing a stock that's already run up out of excitement. Both may feel like decisions in the moment. Both are driven by emotion, not strategy. The antidote is a rules-based approach to investing. Know your plan before the market moves. If you've decided you're a long-term index investor, a 15% drop shouldn't change that. Don't let a bad week turn into a bad decision.
This is one area where women might have an edge. Research has shown that women trade less frequently than men. That lower trading frequency tends to produce better long-term returns. This is not because women are better at picking stocks, but because they are less likely to react impulsively to short-term noise. Patience is an investing skill that doesn't get talked about enough.
Mistake number 3, overconfidence. Men, we're going to have to own this one as well. There is a well-known study from UC Davis that found men trade 45% more than women. That is largely driven by overconfidence in their ability to pick winners and time the market. The irony is that the more confident an investor feels about beating the market, the more likely they are to underperform it. Overconfidence leads to overtrading, under-diversifying, and taking on more risk than you realize.
Overconfidence is less of a pattern for women. But, like we talked about in the previous point, underconfidence is its own problem. That can show up as underinvesting, staying too conservative for too long, or deferring financial decisions to someone else entirely. Confidence in investing is not something you are born with. It is built through doing. The more engaged you are with your money, the more your confidence will grow naturally.
Mistake number 4, analysis paralysis. There are many options out there for investors. Mutual funds, ETFs, individual stocks, real estate, crypto. A lot of people freeze when faced with these choices. They wait to read one more article, watch one more video, and never actually pull the trigger. The research phase matters, but there is a point where more information stops helping and starts delaying. Pick a simple starting point, an ETF like HBF, the Harvest US Equity Leaders Income ETF, inside a TFSA. HBF targets dominant US equities, companies like Apple, Microsoft, Amazon, Walmart, Coca-Cola. These names have unmatched scale, strong financials, and dominant market shares. Then you can build your knowledge from there.
This one connects back to what I mentioned in mistake number 1. The same tendency towards caution and preparation that delays getting started can also keep you stuck in research mode. It's not hard to understand why. Most of us have been told in our life to be careful with money. Doing extensive research before acting feels responsible, but sometimes preparation becomes procrastination. Action creates clarity in a way that research alone never does. In investing, often more is lost to indecision than a wrong decision. Start small, learn as you go, and trust that you will figure it out because you will.
Finally, mistake number 5, not asking questions. This one affects everyone, but for different reasons. A lot of men don't ask questions because they don't want to appear uncertain or admit they don't fully understand something. That ego can make us nod along, make assumptions, and sometimes make expensive decisions based on incomplete information. Your financial future is worth the temporary discomfort of clarifying and asking questions.
For women, hesitation can come from a different place. Research shows women are less inclined to openly discuss finances compared to men. So they may stay quiet, leave the conversation with incomplete information, or even disengage from investing altogether. The cost of silence is real. No advisor, banker, or financial educator should make you feel like the question isn't worth asking.
5 mistakes: waiting too long, trading emotionally, overconfidence, analysis paralysis, and not asking questions. The common thread, they're all behavioral. The market isn't the hard part, we are.
The fact that you're watching this already puts you ahead of most people. Keep asking questions, keep showing up, and don't let perfect be the enemy of getting started.
If this helped, subscribe to Money Focus for more investing content. There's a lot more coming in 2026.